Important tips and resources for buying your home.
Which is nice because California is not on your side as a landlord or a homeowner. Taking a look at an estimate, and now these are just rough estimates as far as the mortgage goes. Bear in mind, you'd want to talk to a lender, which we can provide you with in order to figure out your exact numbers, because if you change any of these, and it's going to depend very, very much on your specific situation, the value of the property and whatnot. So this is underneath the $750,000 of a loan amount that you would need to be into a jumbo loan. So for example, if you bought an $800,000 property and you put 70 grand down, it would bring you have 70 grand into it already. And so the loan that the bank or financial institution is giving you is already below that $750,000 mark. And so now drastically the amount of down payment, well, you had to put a large down payment in order to get it below that. But assuming you were close to it, like it was 760,000, if you put 20 grand down, that would bring you below the jumbo loan mark. And now you don't need to put 20% down because the bank's only giving you a loan on 740,000. For this, we're way in the clear. We're at 667,000. But let's say we want to put a pretty big down payment down so we don't have to pay, that much mortgage insurance or anything. And we put 70,000 down at 10% over 30 years. These are a couple of the estimates. They would give you 2,600, 2,700, but let's add another $100 on that just to be safe and say that, the monthly payment's going to cost you, 2,900 plus the HOA fee of $99 or so. So taking a look at the deal, we've got the purchase price, $667,000, 10% down payment, $70,000, HOA is $100, mortgage rate around 3%. Now bear in mind with the mortgage rates right now, the Federal Reserve, which is the people that loans money to Chase, Wells Fargo, Bank of America, they are trying to keep inflation at a 3 to 5% rate. And they do that by determining how much they're going to charge those banks to loan money from them. And so they can play with these rates however they want. And right now they're trying to artificially keep them low to make sure they're not really sure what the effects of COVID were. And they're kind of confused. And they're trying to keep the rates artificially low so that the banks will then loan money to us for cheaper and so on and so forth. And that enables us to get really low rates right now. And, there's a saying, it goes, I'll give you your price if you give me my terms. I don't care if I have to pay $10 million if I only have to pay 1% a year, because, well, I could pay that forever, whatever. And this is the kind of the business model between companies trying to get you to buy your cell phone and houses and pretty much everything now is kind of on this sort of subscription-based model or to just charge you a little bit over a long period of time. Cars, for example, too. But for a cell phone and a car, it's a depreciating asset. When I can only pay 1% on a $5 million property, if I could, that would be awesome. And the property is appreciating at 5% a year, I'm making 4%. I'm making 400%, 500% of my money every year. So I don't care if I'm paying $1,000 because I'm making 5 bananas for every 1 banana I put in. So taking a look at the mortgage rate, 3%, we're going to assume the monthly payment estimate is going to be around $2,800 plus $241 for the private mortgage insurance, which is the bank essentially saying, hey, we're going to charge you in order to make sure that you're insured for up to around 20% down payment or so. And they're going to charge you that on most of these loans. So you have to take a look at that when you're going through the financing options and make sure you're accounting for that with your realtor or, whoever you're working with on these investment properties. So the total cost of the property for that at that point is going to be $3,096. Then if I was renting out the property, I would try to build the monthly utilities into it. If it's a primary residence, then obviously you can have another $200 to $400 in utilities a month. Build in the HOA fee of $100, and the total monthly cost is going to be around $3,200. So $3,200 is kind of our baseline, assuming that nobody kicks in a wall, breaks anything like that. Now, taking a look at how it's going to make money, assuming that you guys work with us and we're able to go in there and add furniture to the property. Now, you wouldn't want to do this in a market like Fresno or Antioch, or maybe even some places in San Jose, because people are just going to destroy the furniture and stuff like that. But when the average household income is, $120,000 in Brentwood, and you're having some essentially, higher quality prospects come in that are most likely going to take better care of your stuff. They're people that are working at a tech company and they just want a place to lay their head, and they're going to go back and forth to work, and that's about it. It's not that big of a deal to add furniture. People aren't going to be throwing parties and just destroying this stuff.
Join our weekly webinar. Call us now at 408 763 8131 or scan the QR code.